The earnings for the big five tech companies are actually substantially slower than the rest of the market. And the reason is that this is the moment for old economy value stocks. When you have an economy that is surging, when you have more inflation, it helps financials, it helps metals and mining companies, industrials, things of that nature. And it doesn't mean that it's bad for tech, but it just doesn't help tech as much. So tech is dramatically lagging the rest of the market in terms of expected growth this quarter. What we're going to see, though, throughout as the year progresses, not the week but the year, that we're going to see a handoff, and these growth names are going to continue to do really well on earnings, and the value names are going to trail off, and there will be a handoff from value to growth. It's just not yet.
Jonathan, in your notes, you've highlighted something that's rather interesting and a bit contrarian, perhaps. You're saying that, whatever the bond yields are signaling may not be the complete picture, that two wrongs over here could be making a right. Give us more.
Yeah, and so it's a funny thing that when you think about the way an investor, the things that they can get right or wrong, they can guess what the backdrop is. So let's say I think that Tesla's going to do really well and they deliver great numbers, so you're feeling terrific. But the second question is the stock price going to respond to that? What we've seen recently is that interest rates have been falling on the 10-year Treasury, and that's a really negative sign for the market. When we hear that demand for capital is falling and driving interest rates lower, that's really a negative sign for stocks. And yet the market has been rallying. So, we published this note, and it's nice of you to hit upon it, that number one is investors got the wrong call. The market thought that the interest rates were going to rise, and they were wrong. They fell. However, the market thought that if interest rates fell, well, that would be bad for the markets, and the markets went up anyway. So it's been a very robust environment, even though the interest rates are telling you that maybe the economy, because of the the Delta variant and things of this nature, may be a little bit weaker than originally anticipated, and yet the market continues to roar forward with new highs. I don't want to say every day, but consistently.
So where do we go from 4,400? Where do you think we'll end the year on the S&P?
So we have a 4,600 call in the S&P 500, which is about 5% upside. I will tell you, when we put out that market call, people thought that we were just way too optimistic about the environment. We thought that you would see earnings come in this year maybe 15, 20% higher than the consensus view, and that seemed to be quite exuberant in many people's views, and that's exactly what's been happening. The stock market is not getting more expensive. It's the fact that the earnings are going up so much, and the earnings are pulling the stock market. So while many people say, wow, the market's been running, it must be expensive, it's getting long in the tooth, that's not the story. The story here is earnings surprising, stock market keeping pace with the earnings, and the valuations are relatively flat. For the last 12 months, no big valuation story, all earnings.